Dear students and working accountants, all are cordially welcome to my Smart TallyPrime class channel. Yesterday, then in the previous video, we discussed about the history of accounting and then the accounts which are divided into three types, then in the types of accounts and what are the meaning and examples of types of accounts. We discussed everything. Today we are going to discuss further. Now we will discuss about the golden rules of accounting. Before that, one request for you, you please all of you subscribe my channel and press the bell icon next to that. Then select all. Then you will get all the videos notifications whenever I upload the video. And also, while you are viewing the videos, you view the video, watch the video till the end. Don't skip in the middle because if you skip the video, you will not understand the balance topic. So you will not understand the balance topic. So you just watch the full video, and also after watching that, if you feel good, then you please like my video, all the videos. And also when you feel any difficulty, watch the video again and again. If you feel the difficulty or any problem, watch the video again and again, then you can understand. Even then, if you have any problems, you all of you, you post a comment in this particular video. Because if you post the comment, I will understand how I am teaching. I will understand how I am teaching, and I can understand your problems also. So I can try to solve your problems also. Okay. So with this, we will enter into the subject. We will share the screen now. We will enter into the subject. See, yesterday we finished part 1 of day 1, and today we are going to take up part 2 of the day 1 first day because it is a lengthy video. That's why I divided into two parts. Now we understood yesterday what are the types of accounts and what is the meaning and examples. Today we will take up the rules framed for regarding the business transactions because after analyzing and identifying the accounts, and we have to decide which account is to be debited and which account is to be credited. So to decide which account is to be credited and which account is to be debited, we have to follow the rules. These rules are called golden rules of accounting. So these golden rules we have to discuss for each and every account. That is, each type of account will have a separate rule. And depending on the rules, we can decide which account is to be debited and which account is to be credited. So we'll take up one by one. First of all, the first one is personal account. Personal account means persons, any organization, etc., banks, etc. So what the persons, individuals or banks or any organization, what they will do? They may receive anything from us or they may give to us. So only these two, either receiving from us or giving to us. That's all. So in any transaction, if there is a personal account, we have to see whether that person is organization also, whether that person is receiving from us or giving to us. So the real rule is debit the receiver from us and credit the giver to us. Receiving from us, his account is to be debited. If he is giving to us, his account is to be credited. This is the rule. We have to remember these rules even when you are sleeping. If this is asked, you have to give the correct rule. Okay, you have to learn like that. Without these basic golden rules of accounting, there is no accounting at all. That's why you must be very careful. You have to learn it. You should not forget during your whole life. So the rule is debit the receiver means from us, credit the giver to us. Okay. So for this, I will give you one illustration. Goods sold to Ranga 2000 rupees. So we are selling the goods to Ranga. In this case, we have to analyze this as a business transaction because it has money value. So it is a business transaction. But analyze it. Now we have to find out what are the two accounts. Identify the two accounts. So one is goods, and another is Ranga. So goods account is one, and the second account is Ranga. In this case, goods is not a personal account. So that we will learn later. Ranga is a personal account. So first of all, we are discussing about personal accounts. So Ranga is a personal account. We are selling goods to Ranga. That means you tell me whether Ranga is receiving or giving. We are selling goods to him means he is receiving goods from us. He is the receiver. So what is the rule? Debit the receiver, credit the giver. So since Ranga is the receiver, we have to debit his account. See, in this case, Ranga and goods are the two accounts identified. In these two accounts, Ranga is an individual. So it is a personal account. Sold goods to him, so he is receiving the goods from us. So as per the rule of the personal account, Ranga being the receiver from us, his account is to be debited. So what is the result? Debit Ranga account. Then in this account, debit is denoted as PR, pronounced as data. So debit is denoted with PR and pronounced as data. Credit is denoted as CR, pronounced as credit. So debit is DR, credit is CR. So in this case, so Ranga account debit DR, debit or debit Ranga account 2000 rupees. Okay. So next, in this example illustration, the second account in this is goods. It is not a personal account. So we will deal with in other types of account. Okay. Next, number two. Number two is real accounts. Real account means any property or assets. Accounts are related to properties or assets. They are called real accounts. So in this case, any property or asset means what will happen? The asset or property will come to us or into the business, or it may go out of the business. There are two alternatives. Just like personal accounts, either giving or receiving. In the case of real accounts, the asset either comes into the business or goes out of the business. Only two alternatives. So in this case, the rule is debit what comes in means into the business. Debit what comes into the business and credit what goes out of the business. So when the business asset is coming in, we have to debit. When the asset is going out, we have to credit. So first one is debit the receiver and credit the giver. Second real account is debit what comes in into the business, what goes out is out of the business. So this is the second rule. So remember this. Don't never, you should not forget for your whole life. Now, so in the above illustration, we decided, we identified Ranga as personal account. As per rule of personal account, Ranga account is debited. What is the second account? Second account is goods. Goods is a real account. So now we are discussing about real account. So goods is a real account. So in this case, goods is an asset, is a real account. And in this transaction, since we are selling the goods, that means goods is going out. So since the goods is going out, as per the rule of the real accounts, goods since going out, goods account is to be credited. Credit what goes out of the business. Here goods is going out of the business. So goods account is to be credited. Already in the personal accounts, as per personal accounts, Ranga account is debited. Now goods account is credited. So in every transaction, definitely there will be two accounts. One account is to be debited and one account is to be credited, which is a must. But sometimes there will be more than one account also. That will come later. So here, debit Ranga account, the whole transaction recording now. Debit Ranga account or Ranga account debit, and credit goods account, goods account credit. See, I am telling you, in the BCom, this how to pass the generate this data to all this, I am not telling you. I am giving you, I am training you as we require in Tally. So this DR, CR, remember, this DR debit credit in the name of DR, CR. Debit credit denoted with DR, CR. This DR and CR is very much necessary while you are going in the tally. So in the tally, you use this DR, CR definitely. Okay, so that's why you have to remember what is DR and what is credit. Credit is CR, debit is DR. So this is the, so in this example, sold goods to Ranga means Ranga account is debited and goods account is to be credited. Now, next we are going to the third one. Third one is nominal accounts. So what is nominal accounts? Nominal account means expense and incomes. So nominal accounts means maybe either expense or loss or income or gain. So forget about loss or income. It may be expenses or loss incomes. Nominal account means all expenses and income. So if it is expense, what to do? If it is income, what to do? If it is expense, what to do? So the rule is debit all expenses and losses. Either expense or loss, you have to debit the account and credit all incomes or gains. That means if it is a gain or income, then we have to credit that account. Remember, understand? So debit all expenses or losses, credit all incomes or gains. So this is the rule of nominal account. So I will give an illustration. Yeah, salaries paid 50,000. We are paying salaries 50,000 rupees. So in this illustration, we are paying salaries. Means since the salaries account is expense, it is a nominal account. So in this case, salaries is a nominal account. Another one is paid 50,000 rupees, not mentioned as cash, but still paid means what you will pay? Cash only. So paid means it is cash, it is employed. So salaries account and cash account. And salaries account is a nominal account. So as per the rule of nominal account, salaries account is to be debited because it is expenditure. So nominal account, salaries account is debited. And the second one is cash account. Already we know real account. Cash is going out. Which is coming in, debit, going out, that is credit. So cash we are paying now. That means cash is going out. That means we have to credit cash account. So the whole transaction is recorded as debit salaries account and the credit cash account. So debit expenses, credit what's going on. But in this case, not in the books record when I are recording, even in the manual accounting or in tally also, debit and credit we are writing amounts. Salaries account debit means this 50,000 is debit amount and cash account is credited. This 50,000 is credit amount. This is debit and credit. So when you are entering the books, including the tally, debit amount and credit amount are to be entered in separate columns. So debit amount you have to enter first and immediately after the debit account, and after the credit account in the next column we have to enter the credit amount, but both the amounts will be same mostly, but amount may be same or the total may be same. Sometimes one side there is more than one account, so this amount will be divided, so total amount will be equal. So that's why debit and credit amounts are to be shown in different columns. Remember this. Even in tally also, it automatically do it, and even if it is doing automatically, it will do like this only. Debit one side and credit another side, another column. Okay, this is the example for nominal accounts and the nominal account and real account in this example. Next, another one I tell you. Another example, received commission 5,000. In this case also, received means what you receive? Receive cash only. So what are the two accounts here? One is cash, another one is commission, but here commission means commission received. Commission received. So one nominal account and one real account. So in this case, commission is received means it is income. So received means received cash only. So as per the rule of the nominal account and real account, what you do in the real account, debit what comes in here, the received commission means we are receiving cash. Cash is coming into the business, so cash account is to be debited. And received commission means commission is received means it is income. Salaries means paid, salary expenditure. Commission received means it is income. So as per the rule of nominal accounts, what to do? Credit all incomes or gains. So here Commission received is income. So commission received is to be credited. So it is recorded as debit cash account, credit commission received at another place. On the credit side we have to. But here, remember one thing, sometimes some items in the nominal accounts, some nominal accounts may be sometimes expenses, sometimes incomes. For example, salaries definitely is expense only. Commission, discount, etc., some other expenses. Sometimes they are expenses, sometimes they are incomes also. For example, commission. We may pay commission to others. Then it is expense. We are receiving commission here. It is income. So it is better always in the case of nominal accounts. Yet for expenses and for incomes, you maintain separate account, which is better. We can write on account. Commission account only we can write. So in this commission account, sometimes you have to debit the expenditure. If it is income, you have to credit in the same account. But it is better to write a separate account because you will show in the final accounts also separately. That is why incomes and expenses should be shown separately. Even if it is the same account, you have to write separately paid amount as expense, received amount as income. Okay, so this case, the same nominal accounts may be expenses or income. Also, so it is better to open a separate account for income and expense. Okay, so here, are we clear till now? What is the rule of personal accounts, real accounts, nominal accounts, with illustrations, everything. Okay, so here, up to here it will go. And then next one more thing is note here. One more thing is both accounts. Okay, I will come later. Here, sometimes now here in these three examples, one is one account belongs to one type, another account belongs to another type. Okay, but in sometimes two accounts may belong to the same type. Two accounts may be personal accounts, two accounts may be real accounts, but there will not be nominal account. Never two accounts will be nominal account. Either two personal accounts or two real accounts. In such a case, for both the accounts, we have to apply the same rule. One will be debit, one will be credit. For example, see, sometimes both the accounts may belong to the same type, like both real accounts or both personal accounts. In that case, we have to apply the same rule for both the accounts and we have to record. For that, I am doing illustration number 1. Purchased goods for cash. So here, what is that? We are purchasing goods for cash. Means goods we are receiving and cash is going out. So goods coming in, cash is going out. So goods belong to real account. Cash is also real account. So both belong to the same type. Here goods purchase means goods are coming into the business, cash is paid. So cash is going out. Here both belong to the same. So we have to use the same rule. What is coming in, what is going out? Goods is coming in, we have to debit. Cash is going out, we have to credit. So debit goods account, and the credit cash account. So both the accounts are the same type. That's why we have to use the same rule, and one account is debit, one account is credit. Okay, understand? Similarly, I will tell you one more example. Purchased furniture for cash, or suppose sold goods for cash. In such case also, goods and cash. So sold means cash is coming into the business, cash account is to be debited. Sold goods means goods is going out, so goods account is to be credited. Just opposite to this purchase. Goods account debit, cash account debit, credit. In the case of sales, cash account debit, goods account credit. Okay, and here one important thing you have to know, that is here so far in all these illustrations we got one account, goods account. It's a real account, no doubt. But here goods account in the books, goods account is not recorded as goods. It is never recorded in the books as goods account. Okay, it is recorded in a different name. It is goods only, but recorded in a different name because goods will come in to the business or go out of the business. When it will come to the business, into the business, when you purchase, goods will come. When the goods will go out of the business, When you sell, goods will go out of business, isn't it? So when you are purchasing, goods is coming in. When you are selling, goods is going out. But sometimes goods will come in not only when you purchase, when the sales we made, they are returned back. So when you sell the goods, goods is going out. Suppose some of the goods are returned back to us by the customer, the goods is coming in. So then we have to debit the account. But in that case, it is now it is a third account. This is another account. And one more another instance. When you purchase the goods, goods is coming in. When you sell the goods, goods is going out. But when you purchase the goods, when the goods are some of the goods are returned back to the supplier, goods is going out. So when you sell, goods is going out. When you return the goods of purchasing, that is called purchase returns. So in the case of purchase returns, also going out, goods are going out. In the case of sales also, goods are going out. In the case of purchases, goods are coming in. In the case of sales returns, when the goods are sold, if they are returned, they are called sales returns. So the sales returns also goods coming. So purchases and sales returns are debit. Goods coming in. Sales and purchase returns, they are in that case, goods will go out. And these returns are called in another name. Purchase returns means when you purchase goods, we are returning back to the supplier. So returns are going out. That is, goods are going out. They are also called purchase returns, and they are also called returns outwards because the returns are going out. When returning with goods, they are going out of business. That's why they are also called say purchase returns or returns outwards. Similarly, when the goods sold by us are returned back to us, some of the goods, if they are returned back to us, the goods will come in. They are called sales returns, isn't it? So in that case, they are called sales returns. So when the sales are returned back, so goods are coming in. That's why they are also called returns inwards. The returns are coming into the business. The returns coming into the business. So they are called returns inwards also. So number one, purchases, purchase returns called returns outwards. Next number two, sales, sales returns, returns inwards are called as sales inwards. These are the instances for goods coming in and coming out. So in this case, the goods account is not recorded as goods account means it is recorded on the as per the circumstance. That is, when the goods is going out, goods are to be credited. When it will go, when you sell the goods, it will go. When you send the purchase returns, it will go. In that case, we write the goods account in that instance name. When the goods are sold, it is written as sales account. Goods account only. It is written as sales account. When the goods purchased are returned back, purchase returns, they are called purchase returns. They are written as purchase returns, not as goods. Similarly, when you sell the goods on purchase return, when you buy the goods, goods are coming in, but when we purchase the goods, we write it as purchases account, not goods. Goods only, but we write as purchases account, and sold goods are written back. That is written inwards or sales returns. In that case also, goods are coming in, then they are called sales returns or returns inwards. So purchases, purchase returns are sales outwards. Sales or and sales returns are returns inwards. So there are four names for goods. So in every transaction involving the goods, we have to see what is happening and why the goods are coming in or why the goods are going out. And as per the circumstance, we have to write the name. Goods will be written in four names: purchase account, sales account, purchase return, sales return. So four accounts will be written instead of goods. But all the four accounts goods only, but they are written as in a different name. Understand? So in this case, in the above illustration, see, in the above illustration, we purchase goods for cash. Okay. So in this case, goods we are writing. Cash account is credit, okay, no problem. But goods account is debited. But we should not write goods account. So why the goods are coming in? Goods are purchased for cash. So when the goods are purchased, we have to write goods as purchases account. So we have to write debit purchases account 5,000. Credit cash account, there is no change. Cash is going out. Purchases goods are coming in due to purchase. That is why you write as purchase account and credit cash account. Similarly, here, illustration number 2. Purchased furniture for cash 5,000 rupees. Purchase furniture for cash 5,000 rupees. So in this case, you will write furniture we purchased, so we write as purchase account. No. When you write purchases, sales, purchase returns, sales returns, when you write only for goods. So these are the name, different another name for goods only. Okay. What is the good? What is meant by goods? Is not meant here. What is meant by goods? Any article or any goods purchased for resale. We purchase and sell and we get profit. That is called resale. So purchasing goods with the intention of reselling, then only it is called as goods. This is also I said. So any asset purchase for reselling, it is called goods only. But if the asset is purchased not for resale, for use in the business, it is called a fixed asset. Then it is called as fixed asset and it is not recorded as furniture. It is recorded as in the name of the asset. In the name of the asset. Here in this case, purchased furniture for cash. That means cash is one account, furniture is one account. Here purchased is okay, leave it off because furniture is there. Purchased goods means goods. Purchased furniture means furniture. We are purchasing furniture for cash. See in this case, furniture purchased for office use. Furniture purchased for office use. That is why you have to record it as furniture, but not as purchases. Okay. So in this case, both furniture and cash account both are real accounts. So as per the rule of real accounts, asset coming into business has to be debited and asset going out is to be credited. And here, goods is not purchased is not good. Purchases is not goods. We are not purchasing goods. That is why we have to write in that asset account. So recorded as debit purchase account, furniture account, and credit cash account. Understand? So here we are not writing purchase account. Remember, goods means I will take up another class. All the terminology used in accounting. So the same terminology will be used in Tally also. I will take up a separate class giving all the terminology. I mean all the different terms used in they are called accounting terms or accounting terminology. I will take up one full video for accounting terminology. Okay. Okay. Okay, understand this now. Furniture account is debited and cash account is credited. Next. You remember, you see this carefully. If you don't understand, if you have any problem, again see the video once again. And then even if you still you have problem, you can post a comment. Okay, this is a simple thing. This is only intermediate level. You learn all these degrees in the first year itself. You learn all these. That's why it's not very difficult, very easy. Okay, next another illustration. See, sold goods to Krishna and Co. Sold goods to Krishna and Co. 4,200. Here, what are the two accounts? Goods. Another one is Krishna account. There is no cash here. Sold goods to Krishna and Co. Goods one account and Krishna and Co. one account. So in this case, Krishna and Co. is a personal account. Goods is a real account. So Krishna account is to be done. What to do with Krishna account? We are selling goods to Krishna and Co. So what he is doing? Krishna and Co. is receiving from us. So this is a personal account and this is a real account. What is the rule of personal account? Debit the receiver. So in this case, Krishna is the receiver, Krishna and Co. So Krishna and Co. account is to be credited. And then this is debit. And next one is goods. What is happening here? Goods is going out to be credited. But why it is going out? We sold goods. That's why goods are named as sales account. So Krishna account is debited already. And credit side we write sales account. So Krishna account debit, sales account credit. Understand? So goods account is written in a different name. In this case, in the previous example, we wrote purchases. In this example, we wrote sales. In this case, we are writing sales. Now let's go 1 minute. Okay. Right. So here sales goods are sold. So we're writing sales account. Okay. Next. Next here I am writing. I told you already in the beginning representative accounts that I will tell you in a different way. Here we are changing the name of the goods. Similarly here we will change the name of the proprietor also. Here see here. See here now illustration number 4. Started business with a capital of 1 lakh. Started business with a capital of 1 lakh. That means now we have to do started business with a capital. Who will start the business? The owner, the proprietor will start the business with a capital of 1 lakh. Means what is capital of 1 lakh means? It is 1 lakh rupees. That means money, cash. So here one account is cash, and the other account is who is giving the money to the business? Proprietor. So proprietor account should not be written in the books. That's why I told you in the beginning. So here the proprietor account is written in a different name called capital account because whenever the proprietor gives any money or any other items, money or money's worth, okay, in cash or kind, whatever he gives to the business, then it is called as capital. He is giving to the business is called as capital. So in this case, he is giving cash 1 lakh for starting the business. In this case, capital account is another name for proprietor. Another name for proprietor or owner. So it is a personal account. Here, cash is coming into the business. The owner is giving cash as capital. So when the cash is coming into the business, what we have to do? Debit what comes in. So cash account is debited because it is coming in. And next, second one is property is giving property account is to the credited. But here we change the name. He is giving is a written as capital account. So credit capital account 1 lakh. Owner is giver. So debit what comes in? Cash debit. Credit the giver. Owner is giving. Then change the name. Capital account is credited. Okay. In this case, I will tell you one more thing. In for proprietor, there is one more name. That is when the proprietor is starting the business or doing anything to start the business, he is giving to the business. So we are creating his account. Sometimes, since the owner is the owner of the business, as a owner, he can take anything from the business also. Whenever he is giving to the business, he has the right to use anything for his personal purpose. He can take goods, he can take cash, or he can pay any other expenses also, his personal expense also from the business. All these are taken as the proprietor is taking the money from the business. So when he is giving, we are creating his account. When he is taking from the business, his account is to be debited. His account is to be debited. So when you are debiting his account is written as in a different name. When he is giving, you are writing as capital account. When he is taking, his account is written as drawings account. His account written as drawings account. So capital account when he is giving to the business, drawings account when he is taking from the business. Okay. So you suppose in the same case here, not mentioned here. For example, 5,000 rupees he has withdrawn cash for his personal purpose. 5,000 rupees he has withdrawn from business for his personal purpose. In such a case, so he is withdrawing cash, means cash is going out, and he is receiving the money, proprietor. His account is to be debited. So instead of that, what we write instead of proprietor, we write it as drawings account. So drawings account is debit and cash account is credit. So debit, credit, cash account credit, and drawings account is debit. So with this, we understand the types of accounts and the golden rules for all the types of accounts. And all things are very, very important. Very, very important. So without these rules, golden rules, there is no accounting the art. So that's why you must be very careful. You have to learn very well. Okay. So this is the end of the second part of the day 1. Okay. So with this, we close this session. And once more, I am reminding you, please subscribe to my channel and press the bell icon to get the notifications and share this with all your friends. And when you are watching the videos, you watch each and every video till the end and like the video, and everyone you post comment in the comment section of the video, because if you post the comment only, I can understand are you feeling any difficulty, and also how I am teaching you, because whenever whoever is teaching, he feels he's teaching very well, but the others only they will know. If I am teaching, I will feel that I am teaching very well, but you only will know whether I am teaching well or not. If there is any problem in the teaching, then I will rectify that. I will try to teach well, as well as even if it is good, still I will try to improve more. Okay, that's why comments are very much required, and I think you will do, and you will support my channel. And tomorrow, day 2, you take the day 2 in Telugu tomorrow. One day I will make Telugu video, the same video I will make in English the next day, like that. So far, first day, 2 parts, part 1, part 2, both in Telugu and both English, I completed. Now tomorrow, the day 2, I will take up in Telugu, and be careful and be safe. And thank you very much. Thank you very much. And you practice this well. You have to practice. Otherwise, you will not get. If you don't practice, you will not get. That is the clear. Okay. Thank you very much.